Buddy Brian Shannon here from alphatrends.net. Today is Friday, the 2nd of November, 2018. We did get some bounce back here this week. The S&P gained 2.5%. The Russell was up 4%, and the semiconductors led the way up 7.5%. Still down year to date, but we did get some of these columns that had been previously red turn to green here. So let's take a look at the charts and make some sense of this action. Here's a chart with the 200-day moving average. That's that red line, and it's the S&P 500. So it says it right up in here, SPY daily. We've got a 20-day moving average that this market fell short of today, but we are also right at the year-to-date volume-weighted average price. That's that purple line. So what does that mean? It means the average price paid for the S&P 500, adjusted for volume, is $274.35. Meaning at 271.80, the average long participant is down money year to date, regardless of what the index says, up 1.85% year to date. The average participant on the long side is losing money, and the average short is making money. So we've gotten a bounce. We still have a pattern here of we had this previous high over here. We had a low right here. I'm sorry, a low. We had a lower high, another lower low, and this is still looking like another lower high. We're below the 200-day moving average, below the year-to-date volume-weighted average price, etc. So what we want to take a look at are some of the intraday levels that I've been pointing out lately. On the S&P 500, that would include the volume-weighted average price from that peak in October, which acted as resistance here on that first bounce in the downtrend. And then once again here, we saw that it provided resistance. And today, as I pointed out on Twitter, we came very close to that in the pre-market, and that was pretty much the high of the day near the open. So the negative part is that we're still below that, meaning that this sell-off, the sellers are still defending the average price from that peak. Now, as far as the average price from the second peak, we are in a position where the buyers are starting to gain control. Also, from the low that we made this week, the buyers are in control. So next week, this level down here at about 268.5 is going to be an important level to hold above. If we break below that, I think we can see another retest of the lows and probably lower lows and continue from here. So don't be complacent with anything. We have seen that earnings reports have a huge impact on the market this week. We saw that Facebook started to recover a little bit, but even Facebook, if we take a look at that, the average price since the Facebook book earnings 3 days ago, right here, is actually higher than where the stock is trading today, meaning that the average participant on the long side is losing money since buying after earnings, and you can see how that seems to be being defended so far. Of course, the bigger picture on Facebook is still a giant mess here, and what we saw actually happen was kind of interesting, that it was the low from 2015 that so far in this downtrend, the volume weighted average price off that level is where the buyers are trying to get the stock to stabilize, but it's still clearly in a horrific downtrend, and in my opinion, not something that you want to be trading on the long side. The Nasdaq, we discussed at length that double top and the overshoot of the downward objective in that market. And this market this week, obviously, we have the same pattern: lower highs and lower lows. We have a declining 20 and 50-day moving average. That 200-day moving average is flattened out. If we erase all this stuff, you can see we found resistance at that 200-day moving average, and we're also below the year-to-date volume-weighted average price for the Nasdaq. That's this purple line. So it's still in trouble. Basically, is the quick and dirty look at this market. Now, can it turn higher? Of course it could, and the important level of resistance for next week is going to be about 172.5. But it's very difficult to trust a bounce attempt when we have a declining 50-day moving average. So if you're trading on the long side, generally don't expect these rallies to hold. And when they do fail, start to move to the sidelines quickly. The support level that, again, we want to see actually probably down towards 167.5, because that's also the conjunction of what was the week to date volume weighted average price and the volume weighted average price off the low right in there. So I think that if we see something like this, nothing to get excited about. But then if we see, something like this, and then further downside, then you've got to really be alert. The Russell 2000 did bounce back as well this week. It's still, really even worse than the other markets, although I guess it's right at the 20-day moving average. You can see we're well below that red 200-day moving average and the green 50-day moving average. When we look at a weekly chart, I mean, this is a market that is due for a bounce, and maybe it goes all the way up to 160, but it's still a broken market. So be very selective in the stocks that you trade. And as always, risk management is job number one. I say that regardless of we're in a bull market, a sideways market, or a bearish environment as we are now. But the fact is, this is the time when people begin to realize why I say that phrase over and over again. Semiconductors, as we said, had a stronger bounce this week. They are still below a declining 50 and 200-day moving average. If you're into the death cross, that's this right here, where the 50-day crosses the 200-day moving average. But we have, again, a declining 20, 50, declining year-to-date volume-weighted average price. And when we look at that weekly chart, this is a big stage 3 distribution. And it's likely that if we, maybe we get some further bounce just to mess with the shorts, but it's likely to pan out like that. I think that's what's most likely. If you're long in here this week, that was the proper course of action. Hindsight can tell you perfectly that, breaking above this little area of resistance was exactly where, if you were to get long, that's where it made sense. It didn't make sense to get long in here, not from a risk reward standpoint, but from where the buyers took control. Now we want to be aware of this level right in here, basically 93.5 to 94. That's where we have the volume weighted average price from the prior swing high over here, as well as the volume weighted average price from last week and from this week's low. So again, pattern of lower highs and lower lows here. It's guilty till proven innocent in my mind. The biotechs also broken year to date, below that year to date volume weighted average price. If we take a look at, let's go back and take a look at this 65-minute chart. Here, the volume weighted average price from the recent peak also acted as resistance in here, and then once again this week. So these volume weighted average price levels are showing us areas where sellers are clearly coming into the market that might not be seen from a traditional, simple moving average, exponential moving average, or other traditional tools, which is why the volume weighted average price, the anchored volume weighted average price, is such a powerful tool. And by the way, for those of you who ask, uh, the software here is TC2000, and there's a link on my site where you can get a $25 off your first month, which basically gives you a free month. But this tool right here, the anchor right here, as you can see, is called the Anchored VWAP by Alpha Trends. They developed this for me a couple years ago, and it's really been a hugely important tool, as you can see, in identifying key levels of support and resistance in the markets, regardless of what market it is you are looking at. So the financial stocks also clearly broken. They made it back to this prior support, which is starting to maybe show some resistance. We've got a declining 20, 50, 100, 150, 200-day moving average. That's what a bearish trend is. It's when it's below all those moving averages, and those moving averages are declining. Then we see prior bands of support act as resistance, and then another leg lower typically develops. So don't get too comfortable just because we've had a bounce this week. Energy names really, kind of look the same as well. We saw that failed breakout over here 3 or 4 weeks ago led to a sharp move down. I warned last week that we didn't want to be getting short on a break below this level, because that's the uneducated shorts who are putting their stops under there or thinking the world is going to end because the year to date low was broken. Those typically get a bounce, but those bounces typically do not hold. So we want to look at things like the volume weighted average price from this gap down or from this low. And you can see that those now come together with this orange, which is a 5-day moving average, and that tells us that this little band of support in here, if this is broken between 66.75 and up to 67, then this market is likely to continue lower. Now, maybe it doesn't do it right away. Maybe it does something more like this for a couple days, comes down, and then rallies back up above, to it, and then starts to break lower. So that'll do it for me for now. Actually, let's talk about Apple real quick because Apple's broken. And, we knew there was trouble coming into Apple as it spent so much time with that volume weighted average price from the prior earnings report. And it had been stuck below the declining 5-day moving average and the volume weighted average price from this peak here. So Apple's going to need time to heal. It wouldn't surprise me to see it coming down towards about 195. It's interesting that the last quarter's earnings report, which was right over here in May, is where this market slowed down today. So I think that, for Apple, maybe it continues along in here for a while, and then a breakdown of the 200-day moving average year-to-date VWAP, close this gap in the prior resistance. That's what seems most likely. So risk management is always job number one. Thanks for tuning in.